Welcome back to Investing Talk Podcast. Today we're tackling a question that honestly a lot of you have been asking. Is Honeywell a good time to buy right now? We've spent time sifting through quite a stack of recent analyses, financial reports, and, the latest market news to try and bring you the clearest picture possible. Before we get into the specifics of Honeywell, just a quick reminder, if you find value in these discussions, please remember to subscribe, like, and maybe leave us a comment. It really does help us bring more of these analyses to you. And hey, if you have a specific company you'd like us to look into, definitely leave a comment below after our discussion today. We do read them. Okay, let's unpack this. We're going to walk you through Honeywell's recent performance, take a look at their financial health, see how they stack up against competitors, and try to figure out what the valuation metrics are telling us, maybe even touch on some key technical indicators. We'll also look at recent news, any upcoming catalysts, and importantly, the risks involved before giving you our overall summary. So where do we even start with a company like Honeywell? It's so big. For me, it usually helps to first just talk about their core business and their recent financial results.
Yeah, absolutely. What's really fascinating here is Honeywell's position. They're a diversified leader across several, really critical sectors.
Right.
Aerospace, industrial automation, building automation, and increasingly, energy and sustainability solutions. They really serve international markets, and their strategic shift towards connected systems and software is actually enhancing customer dependence, makes them stickier.
Stickier.
Yeah, like harder for customers to switch away. And that potentially lowers operational cyclicality. It supports a really durable economic moat, that competitive strength for them.
Okay, that makes sense. Building a moat. And what about their recent numbers? Were they impressive?
Oh, absolutely. Honeywell posted Q2 2025 net sales growth of 8%. Solid organic growth, too, actually exceeding their own guidance, which is always good to see. Earnings per share came in at $2.45, with adjusted EPS at $2.75.
Adjusted EPS is usually a bit cleaner, right?
Exactly. Strips out some of the one-offs. And looking at the bigger picture, their trailing 12-month revenue stands at just under $40 billion, $39.99 billion, and net income at $5.72 billion. They saw 5% revenue growth in FY 2024 and even managed flat, but still positive earnings growth of 0.83%. And the key thing, management raised their full-year guidance for organic growth and adjusted EPS. That shows confidence.
That does sound strong on the top line. Confidence for management is key. But how's their financial health beneath the surface? Balance sheet stuff.
Right, that raises an important question. While net debt remains, I'd say, moderate relative to cash flows, which is good, their quick ratio is something to keep an eye on. It's between 0.83 and 0.97.
And ideally, you want that above 1.0, right?
Ideally, yes. Below 1.0 indicates that liquidity, well, it's something to monitor. Doesn't mean they're in trouble, but it suggests maybe less immediate cash for short-term needs compared to some others. However, they did reiterate their free cash flow guidance, and importantly, they've completed major transactions, acquisitions, divestitures, really trying to optimize their portfolio.
Okay, so strong performance, but maybe keep an eye on that quick ratio. Got it. Moving from how they're performing to, well, what they're worth. Let's look at valuation. What do the key ratios tell us?
Okay, valuation. If we connect this to the bigger picture, their price-earnings ratio, the PE, is 24.79. The forward PE looking ahead is lower at 20.29. The price sales PS is 4.01 and price book PBE is 8.85.
And how do those numbers compare to their peers, like say 3M or maybe General Electric?
Yeah, it's insightful to compare. Honeywell's PE of around 23.9, let's call it 24, is higher than 3M's, which is closer to 20.5, but it's significantly lower than General Electric's PE, which is way up near 48.
Wow, big difference with GE.
Huge difference. Now for PB, Honeywell's at 8.85, 3M is much higher, 18.44, and GE is 13.68. So Honeywell looks cheaper on a book value basis there. On PS, price sales, Honeywell's at a 4.01. That's higher than 3M's 3.43, but lower than GE's 6.77.
So putting it together, these current valuation metrics suggest the stock trades at a premium compared to its sector and maybe its own historical averages.
So it looks a bit pricey based on those standard comparisons, but sometimes those simple ratios don't capture the whole story. What about more in-depth valuation models like DCF, discounted cash flow?
This is where it gets really interesting. You're right. Discounted cash flow, or DCF, and fair value estimates from Morningstar, for example, place Honeywell's fair value way up at $339.
339. Wow.
Exactly. And with the current price hovering, around $216 to $240, this suggests the stock could be undervalued by roughly 42% if that estimate holds true.
42% undervalued. That's
Right.
significant. It is. And furthermore, analyst price targets, if you look at the average, they come in around $250 to $254. That indicates a potential, say, 15% to 17% upside over the next 12 months. So a different picture than just the PE suggests. Okay, that's a really important contrast. Standard ratios look pricey, but DCF suggests significant undervaluation. Yeah. Interesting. Beyond the fundamentals and valuations, what's the market action telling us? Any strong technical trends or recent news driving things? Sure. Looking at the technicals, Honeywell stock recently traded in a range, roughly $216 to $219.50 for the day we looked. Its 52-week range has been wider, obviously, $170 in all dollars up to about $243. So near-term support looks like it's around that $216 level. Resistance, where it might struggle to break higher, seems to be in the $240, $250 zone, which interestingly aligns with those analyst targets we mentioned. The trend generally seems positive, especially reinforced by that 8% Q2 sales growth and the raised guidance. Its beta is 1.07, so moderate volatility, pretty much in line with the broader market. And momentum indicators like RSI and MEMS-ED, they suggest stable conditions, not overheated or overbought right now. Seems healthy.
Good to know it's not looking overheated. What about recent news that might be moving the needle? I think I heard something about acquisitions just recently.
Indeed, very recently, actually. August 20th, 2025, Honeywell's stock saw a jump in trading volume. It ranked pretty high in market activity that day. That was after they announced the acquisition of 3 utility platforms from a company called SparkMeter, specifically Praxis for data analytics, GridScan for grid monitoring, and GridFin for financial management tools.
Okay, utility platforms. What's the significance there?
Well, these are designed to integrate right into Honeywell Forge Performance Plus for utilities. It's all about enhancing grid modernization, which is a huge growth area. And this move fits into their broader restructuring strategy. They've also talked about planned spin-offs of aerospace technologies and Solstice Advanced Materials. It complements about $14 billion in strategic acquisitions they've made since mid-2023, including prior buys like Compressor Controls Corporation and Scatafence.
$14 billion in acquisitions. Wow.
Yeah, they're actively reshaping the portfolio. This latest acquisition targets critical gaps in utility operations, aligning right with the global energy transition trends. It's quite strategic.
Definitely sounds like they're making big moves. And what's the overall sentiment around the company right now? Analysts, social media buzz?
Analyst sentiment is largely positive. Lots of buy ratings out there. Although it's worth noting, some major banks have slightly adjusted price targets downward recently, suggesting maybe a touch of caution, perhaps related to macro factors or that valuation premium we discussed.
Okay, mostly positive, but a little caution creeping in.
Exactly. There hasn't been major insider buying reported, which is always something to note. But generally, social media chatter and analyst sentiment lean bullish, with a few holding back with moderate or hold ratings, usually citing those macro and valuation concerns again.
Understood. Are there any upcoming events or things on the horizon that could act as catalysts for the stock price?
Well, for the short term, the next big thing is the upcoming earnings report, expected around July 24th, 2025. That's always key. We'll also be watching for the finalization of those strategic reviews they've been doing for their guidance updates, and of course, seeing the impact of these recent acquisitions and divestitures start to show up in the results.
Proof is in the pudding, right?
Exactly. Long-term, the catalysts are really about their ongoing portfolio optimization and their expansion into these big secular trends: sustainability, automation, software-driven platforms. And naturally, any regulatory or macro shifts affecting industrials, defense, and energy will always be factors to watch.
Makes sense. Okay, we've talked opportunities, but no investment is without risk. What should our listeners be aware of with Honeywell? What are the downsides?
This raises an important question. What are the potential headwinds? On the stock-specific side, that quick ratio below 1.0 we talked about, it might pressure short-term cash needs, so liquidity definitely warrants caution, just something to monitor. There are also integration risks from all these recent acquisitions. Bringing new companies into the fold isn't always smooth sailing.
True, integrations can be tricky.
Very. And, like any big industrial, margin compression is always a risk if inflation or input costs spike unexpectedly.
And what about broader market or sector risks, given their global reach?
Yeah, if we connect this to the bigger picture, industrials, automation, aerospace, these are inherently cyclical sectors. They get hit harder by macro trends like a recession.
So an economic slowdown could hurt them.
Definitely could impact demand. Plus, regulatory and geopolitical risks are always a concern for companies with global operations like Honeywell. Trade issues, regional instability, those can always pop up.
Right, the global aspect adds complexity. Okay, so after looking at all of this, the strong fundamentals, that interesting valuation picture, the market activity, the news, and the risks, what's the final takeaway? Is Honeywell a good time to buy now?
Well, what's fascinating here is that Honeywell really shows strong revenue growth. They've been making smart, prudent moves with their portfolio realignment. Earnings have been resilient, and they've given upward guidance revisions. It's clearly a market leader benefiting from these huge secular trends: automation, sustainability, software integration. And while, yes, those standard valuation metrics show a premium relative to the industry, that risk seems pretty well balanced by the robust upside potential we see from analyst targets, and especially that DCF fair value estimate.
So weighing the pros and cons.
Exactly. You weigh the premium valuation and liquidity watch points against the growth, the strategic positioning, and that potential undervaluation based on intrinsic value.
So what does this all mean for someone considering investing? What's the bottom line?
Based on our review of the sources, the overall rating comes out to about an 8 out of 10. It seems better suited for a long-term investment horizon.
Long term. Okay.
Yeah. While short-term trading could maybe capitalize on earnings momentum or acquisition news, its core value proposition, its strategy, its competitive moat, that really makes it preferable for investors with a multi-year outlook. It's not really a quick trade stock, in my view.
So more of a core holding for the long haul. What stands out to you from today's discussion about Honeywell? It really feels like a company making big strategic shifts for the future, doesn't it? Even with those short-term things to watch. As you, our listeners, consider your own investments, just remember that understanding both the opportunities, like that potential DCF upside, and the risks, like liquidity or cyclicality, is absolutely key. We really hope this analysis has given you a clearer picture of Honeywell and helps you feel more well-informed in your decisions. Join us next time for another exploration of the financial world.